fund investments are subject to market risks. Read all scheme related documents carefully.
Investment in securities market is subject to market risks. Read all the related documents carefully before investing. Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Investment in securities market is subject to market risks. Read all the related documents carefully before investing. Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
Good evening. Can I request everybody to take your seats? We'll start in about 3 or 4 minutes. Okay, friends, we are starting. So once again, requesting if you can take your seats. So good evening, friends. Thank you so much once again for coming to the 28th Wealth Creation Study presented by Raamdeo Agrawal. My name is Akhil Chaturvedi, and I'm the Chief Business Officer at Motilal Oswal AMC. And on behalf of the entire Motilal Oswal group, it gives me immense pleasure to welcome you all out here physically, as well as those who are watching us on YouTube Live. So thank you once again for taking your time out and gracing this occasion. As you know, wealth creation studies have always been very special to Motilal Oswal group. It's that time of the year where Raamdeo ji puts a lot of efforts to come out with interesting insights on and new insights and learnings on the Indian capital markets. So wealth creation study is an annual event which gives a unique and interesting perspective on Indian capital markets. The study obviously is split into two parts. The first part of the study basically looks into a lot of data in the last 5 years, trying to look at companies which have been the most fastest growing in terms of wealth, consistent growing, and the biggest growing. The second part of the presentation is a thematic presentation, which is where the interesting insights will come through the presentation. So today we are all gathering here to witness the results of the study which has been put in by Raamdeo Agrawal. I think the title of theme of this presentation is Hockey Stick Approach to Creating Wealth in the Indian Stock Markets. So today for this, in this event, we are pleased to have Mr. Raamdeo Agrawal, who will present the 28th Wealth Creation Study. So it's really quite something that for the last 20 years, without any break, he's done year on year these studies, and these studies have actually been the foundation, of Motilal Oswal AMC, our QGLP investment philosophy. So to introduce, while he does not need any introduction, but there is a big long introduction for Raamdeo Agrawal, but for the benefit of all, I'll try to give the detailed introduction of Raamdeo ji. So he is the chairman and co-founder of Motilal Oswal Financial Services with a career spanning over 40 years. Mr. Agrawal is a distinguished figure in capital markets, renowned for his expertise in stock picking and wealth creation. He is an ardent follower of Warren Buffett and a great admirer of Charlie Munger. Mr. Agrawal has been a trailblazer in implementing the QGLP investment philosophy followed at Motilal Oswal Group. His insights derived from the 28 years of wealth creation study releases have helped millions of investors to understand and analyze the equity markets with an evolved maturity. Today, we have the privilege of hearing from the markets visionary who has dedicated his career to understanding markets, implementing successful investment strategies, and contributing significantly to the financial services landscape. To share the wealth creation study with us, please welcome Mr. Raamdeo Agrawal, Chairman, Motilal Oswal Financial Services, a stalwart in equity research and a force behind the strong research capability at Motilal Oswal Group. So, sir, requesting you to please come. Thank you so much.
Good evening, friends. It's a pleasure to again stand up here and present 28th Wealth Creation Study. It's always a, a bit of tiredness, and at the end of 2-3 months of this study, the insights are so many. You got to collect it and put it in paper. I think putting the paper is more difficult than actually doing the studies. So here we are. We have somehow assembled everything and put together. And let me, in this 40-50 slides, I will try to, in next 45 minutes, put before you what we have learned, what I have learned about the markets and about investing. So actually, this year's study is inspired by a book called Strategy Beyond Hockey Stick. So that's a book I read 5-6 months back. I said we'll convert this strategy book into a wealth creation study, and here we are. So hockey stick returns, I mean, that's about hockey stick strategy, and in the stock market everybody wants hockey stick return. Hockey stick returns means a return of about more than 25% for 10, 12, 15 years compounded. And that gives you a hockey stick kind of formation when you draw a chart of your return, stock price. So what it takes to get those kind of companies, those kind of returns, we'll talk about it. So presentation is in 3 parts. Wealth creation findings between 18 and 23, hockey stick returns, the power of economic profit, and market outlook. So study methodology, concept of wealth creation is the process by which a company enhances market value of the capital entrusted to it by its shareholders. This is the biggest game in town, and the amount of wealth created worldwide are running into trillions. I mean, it's a $100 trillion global market, and yearly, if there is a 10% return in the global equity markets, it's about $10 trillion of wealth being created. So it's the biggest game, and in India, we create about 12 to 15% every year on a base of now 360 lakh crores. So if you do 12%, you're talking about 35 to 40 lakh crores of net wealth created every year. And net wealth created is a change in the market cap over a study period of 2018 to 23, adjusted for corporate actions like equity dilutions, share buyback, etc. So total amount of wealth created in last 5 years is about, by top index beating companies, top 100 index beating companies, is about 70 lakh crores. So this number, when we started in 2006, it was about 14 lakh crores. Now it has become 70 lakh crores. So this number is growing every year, and then it takes a big leap. Like last year was a flat year in the index, so that's why it is 70 lakh crores. This year, it will see a huge jump. Maybe it will cross to maybe 100, 105 lakh crores, 110 lakh crores of wealth created in the next study. The pace of wealth creation is about 21%, and market has done about 12% compounded. So we have 4 categories: biggest wealth creator, fastest, most consistent, and all-round wealth creators. So the biggest wealth creating company is Reliance Industry in last 5 years at 22% compounded. So it sounds that large companies cannot make money, but they have not only made sizable wealth, but they have also made at a pace of 22%, TCS 18%, ICICI Bank 26%, Infosys 20%, Bharti Airtel 16%. This has made a comeback after a long time. Hindustan Unilever, State Bank, Bajaj Finance. So these are top companies at the average rate of about 21%, and they have literally made 50% of all the wealth created by top 100 companies. The fastest companies, I mean, these are all lucky strike. Lloyd Metals grown at about 80% compounded, Adani Enterprises, Tube Investment. So all these fast wealth creating companies, they come from various corporate actions and some kind of even lucky strike in some resource allocation and things like that. So these are companies which we may not be knowing 5 years back this company can ever make it. Then you have the most consistent wealth creators. So Capri Global is 5 out of 5 years. Warren Beverages 5 out of 5 years. They have outperformed in 5 out of 5 years. Then you have Tube Investment, Linde, Adani Power, JB Chemical, SRF. They have done 4 out of 5 years. They have outperformed. All-round wealth creating companies, if you look at biggest, fastest, and consistent ranks, Adani Enterprises stand out at the fastest or largest all-round wealth creators. Then Varun Beverages, Adani Power, like that the list goes on. Among the industries which have wealth created, that is technology, IT has been the biggest wealth creator in last 5 years at 14 lakh crores. Out of 70 lakh crores, 20% has come from technology. And I mean, look at the share of profit, last column, and share of wealth created is just the same. Whereas the consumer and retail, they have created 17% of wealth, second biggest, and their profit share is just about 7%. Banking, finance, third category. So these three itself have done about 50% of the wealth creation in the market: technology, consumer, and banking. And then oil and gas led by Reliance. So these are large ones. Telecom has made a comeback. Cement and auto, they have taken a very low back seat. I'm quite sure as the time passes, these segments, starting from here, and then realty is literally nothing. I mean, neither they have made money, nor they have been featured in the wealth creation, but it's a very large segment. In China, 30% of GDP is realty. Now I think the change in the trend, this particular thing tells me that this is bound to rise as we go forward. We have seen in the first 6-7 months, but as we go forward, I think realty will assert, and this segment will become bigger wealth creator than what it is right now. I think this is a very interesting chart we have been producing every year. In 2005-06, PSUs used to be 45-50% of wealth being created by all the listed PSUs. These 120 odd PSUs are listed, and they used to create 50% of all the wealth. It became zero last year. In 2022, there was no wealth being created, meaningful wealth, by any of the companies. You cannot have more contrarian kind of a chart like this. And then this year, it has gone to, this is 22, 23, so this is 23. 6% of wealth is created by PSUs, and if you do the same number today, it might turn out to be 10 or 11%. So I think there's a clear turnaround in the fortunes of PSUs to some extent by better management, and in some measure, the outlook also changing. And since private sector have been taken to a different heights altogether, I think this is a high time that PSUs also re-rated from the depth of pessimism. The valuations have, I mean, more changes we have seen over the studies in the wealth creation. So earlier what used to happen till about 2014-15, low PE companies, they used to give us the highest return. Today, if you see, there is lowest P has given the lowest return. This is a change of the marketplace. Till 2015, it used to be less than 5, less than 10 P multiples would give, say, 20% is the average return. It will be more like 35, 40%. And then as the P multiple used to rise, the return used to go down. Now, 25 to 30 P, which is almost like a very high P kind of a grade, that has given the highest return. So I think this is a changing landscape of the market. Look at the price to book. The cheapest price to book, companies have not given the biggest return. It is price to book 5 to 6, that has done better than the price to book 1 or 2. Price to sales, same story. Payback ratio, which used to be our proprietary ratio, is somewhat better, but this is with the foresight of the 5 years of profit growth. So that is somewhat better, but still not telling the full story. The only ratio which is still working well is the PEG ratio. So if you have forecast of the 4-5 years of earnings growth, and if you can buy at less than 1 PEG, if the growth rate is something like 40%, and you can buy at 20 P multiple, I think like that, but nobody can ever have clear understanding of growth rate for next 5 years. But if you had the perfect foresight, then you could get the returns which is at least for less than one peg, you are getting 29%. But otherwise, market is extremely well adjusted for the growth. So market has done its numbers, and it doesn't leave much for the growth companies to be capitalized by people like us. The list of wealth destroyers. Vodafone is 140,000 crores. So total wealth destruction during this period is about 17 lakh crores. And of that, a lot of it is coming from the financial sectors. I think 2020 COVID and all, the elimination of Yes Bank, India Bull Housing, all of them, they have been, even 2 insurance companies, General Insurance and New India, they also have been contributed to the wealth destruction. So, can I have some water? So, coming to the hockey stick returns, the power of economic profit. So this is the book I was talking about. This is a book on strategy. I think I found, even for understanding strategy and looking at a company, I think this is a very good book to read, and I would recommend that people should buy this book and read it. It's a 250 pages book, but worth the effort. So what is hockey stick returns? Sharp, sustained rise in stock prices. So 60%, 65% kind of growth. I mean, these are the best of the lot. I mean, we are talking about hockey stick return. Anything for 10 years has given 25% compounded growth rate. So what happens is, at some point of time, the rise, because of the base, it becomes a hockey stick kind of a formation. So whether it is a Tata Elxsi, SRF, Bajaj Finance, Astral, PI Industries, Ratnamani Metals, these are the companies, I mean, when you look at the numbers, they look crazy. I mean, hockey stick, what causes this hockey stick return? And even I was a bit surprised that the profit growth is at about maybe 25, 30, 35%. But the P rating, year after year, is more like 20, 29, 30, 23, 23, 12, 26. So re-rating of the re-rating of the stock, the P multiple re-rating is stunning. So if you see the P for Tata Elxsi, in 2013 the stock was around 19 P. Today it is at 100 P. SRF from 4 to 42, 10 to 62, 14 to 85. So, I mean, these businesses, these companies were not unknown or broadly ignored by the market in 2013. And that P, the price at which they were available, and when they delivered the earnings growth, so the double engine kind of a thing, where earnings growth is there and P re-rating is happening, the pace of re-rating, I mean, this can happen only in India probably. I mean, nowhere in the world this kind of thing is possible. And we are going to see more of it as we go forward. So conventionally, earnings implies accounting profit. We suggest economic profit as a superior metric. This book suggests that the performance of the companies should be measured not in terms of accounting profit or net profit, it should be measured in terms of economic profit. What is economic profit? What is the difference? The main difference between economic profit and accounting profit is very simple. See, all the costs are homogeneous for all the companies in all over the world for when you talk about net profit. But one problem is, it doesn't consider the level of net worth or equity used to earn that particular profit. So the only difference, I mean, in the current accounting, I would say deficiency, is that how much equity you use to earn that profit is not being charged. It's not being equalized for that. So I'll give an example. Economic profit is equal to accounting profit minus equity charge, because you're not charged for the equity. And somebody uses little equity, somebody uses lot of equity. So equity charge is net worth net worth into cost of equity, that is 10% in our case. So we charge the cost of the capital charge is at 10% of net worth. So EP is equal to profit, net profit minus 10% of the net worth. So by example, in IOC's PAT, in 2023, the IOC had a PAT of 9,800 crores. So that was a net profit, and Nestle had 2,400 crores. Net worth used by Nestle is 2,500 crores, whereas Indian Oil's net worth was 1,40,700 crores. So ROE is 96%, here it is 7%. The year-end market cap is 1,89,000, it is 1,10,000 crores. But P is 7911. What explains this difference is this, that Nestle makes EP, whereas actually IOC makes an economic loss. So accounting profit is whatever, 2,400, 9,800. Net worth is whatever. Cost of equity is 10%. Equity charge is 250 crores for Nestle and 13,000 crores, 14,000 crores for Indian Oil. So actually, Nestle has an economic profit of 2,000 crores, whereas Indian Oil has economic loss of about 4,000 crores. And that explains that, so whenever ROE of any company is less than 10%, though it is profitable and it shows a lot of profit, that doesn't mean that they're actually earning profit. They're actually not, on aggregate basis, I'm just making loosely, that they are not making true profit. It is accounting profit, but the equity use is so much that if you charge for the equity, they have actually not made any value addition to the equity given to them. So economic profit as a superior metric to accounting profit, as it captures the true profitability of the company after charging for economic cost of equity. Portfolio comprising only economic profit companies. So we said, let's prove it. I mean, let's figure out what does the market do? Because it is new for me, probably it is new for the market also. So does the market behave in different fashion than the way we are looking at it? And here, this slide is looking slightly busy, but but this is every year, all the 500 companies, you see the first column, it is a 500 companies return, S&P 500 return for every year. Then you have the return for 500 companies. We said, let's look at the companies in 2013 with the economic profit. So about 300 companies were with the economic profit, and all those companies with economic profit. In 2014, it had a return of 25% in the first column against 18% of the market. So it had an outperformance of 7%. Like that in 15, 34% of the market return, 72% was for the entire bucket of 300 companies. So outperformance was 39%. Like that, in the second column, you see blue one. Economic profit, 7%, 39%, 8%, 13%, 4%. Then 2 years of underperformance. Then again 3 years of outperformance, 22, 5, and 0. So if you look at the compounded return, you come to the extreme right. There, you see that 8% is the average outperformance just by buying bucket of companies with economic profit and 6% compounded CAGR outperformance. But if you are buying companies without economic profit, in that case, actually, you are making only 2% outperformance, or actually on a CAGR basis, 2% loss. Actually, 2% loss through the entire thing. So the economic profit companies, they clearly demonstrate 8 out of 10 years, they have done very well, and on a CAGR basis, 8% outperformance. If you have 8% predictable outperformance in your portfolio, you know how much money you can make, how much money you can manage. It's crazy. I mean, this is not sophisticated. This is very simple, what you call classification. Just to prove the point, the companies with economic profit, they do far superior than companies without economic profit. Some more insights on EP. Study universe, we have put in this is what exactly this book is saying. You put 500 companies in quintile of 100 companies each on a market cap basis. We computed the economic profit for all of them. We ranked them in order of EP and classified them to 5 quintiles of 100 companies each. quintile 1 representing the top 100 and quintile 5 representing the bottom 500, bottom 100. This gives us the economic profit curve. I mean, this itself was a big kind of a learning for me that the curve falls like this. Always this economic power curve will always be like this. So when you make the chart for even net profit, it will always be concentrated at the top quintile. You look at the profit made by the top 100 companies. Out of say 150,000 crores of economic profit, which is after charging for cost of equity, 1,40,000 crores is by the first quintile. 1,40,000 crores. Only 10,000 crores is second quintile. And 2,000 crores for third quintile. Fourth quintile is a loss of 4,000 crores. And fifth quintile loss of 83,000 crores. So all the profit is in the first quintile. So he is saying, this book is saying, what should we do to get to the top quintile of the profit making? Because this book is about the strategy. He is saying strategy to get to the top quintile of profit. Everybody would like to be in top quintile. The money is at the extreme. Loss is also at the extreme. Profit is also at the extreme. And this power curve looks like this. So we have to find companies which are going to go to the top quintile. Somehow they end up in top quintile. That is a strategy for this. So what do we do? So we'll talk about that. So this is company. So those are 5 quintiles. So this is the companies which move up the economic power curve, generate healthy returns. So when the quintile moves, a company which is in quintile 4 or quintile 3, that goes to quintile 2 or quintile 1. Basically, you should end up in quintile 1. And that gives you from quintile 4, quintile 3, quintile 2. If you go to quintile 1, of course, it's obvious that you make a lot money. So 25, 43%. So like that, we have, that was for one thing. And this is for five observations of 10 years each. And here we find that it pays to end in quintile 1 or 2. You must start from anywhere, but you must end up in quintile 1 or 2, or it pays to start, don't start from 4 and 5. A lot of people, they try to do from a loss-making company or very marginal company, you would like to reach the top. It will never happen. You have to start from the mid, and we'll talk about that, why you should start from the mid to reach to the top. And when you are able to do that, you'll realize that your profits are going to be upwards of 20, 25%, and depending on your luck and some of the ideas, it could be 30, 35% also. So he has talked about the strategy to find these companies are TEM, trend, endowment, and moves. So these 2-3 slides are a little tough, but this is what is the core of the strategy to get to these companies. So we are not telling you which company will do this particular move of quintile from 3 to 1, but we'll tell you the process by which the author is suggesting one can go and find ideas which will go from 3 or 2 to 1. So he's talking about trend. I can tell you trend is all over the world in the sense that across the economic landscape, across all the 500,000 companies, there is always a trend. And trend is, I mean, in technical terms, trend is your friend. Let me tell you, as an entrepreneur, forget about as a, stock picker, trend is everything in even entrepreneurship. I can tell you, in Motilal Oswal, we have done everything possible in last 10, 12 years. Between 2008 to 2010, we started 4-5 businesses. We did well also in some of them, but all put together, nothing much happened between 2008 to 2018. Because capital market was very dull. Economy was doing well, rather, but capital markets were dull. They were growing at 4-5%. The client additions were very muted. All sorts of problems were there. Come 2018, and the trend changes. And you see what is the power of the trend. I mean, our profits go by 8-10 times in 2-3 years, 4 years. Because now the economic trend, the participation by retail, and the size of the capital market expansion is extremely rapid. So trend is very important. I mean, I have seen companies after companies, when the trend changes, trend in the price, cost, volume, whenever trend happens, I mean, we talk about, so the trends can have any definition. Trends are directional shifts in a broader economy, various sectors, technology, consumer behavior, etc. And these create opportunities for some businesses and threats for others. When there is a trend positive for somebody, it could also turn out to be negative for somebody. So like environmental concern, electric vehicles, it can have a lot of impact on the IC vehicle companies. Digitization, food delivery, quick commerce, this can create challenges for restaurants, mom and pop stores. A lot of stores are getting challenged by the all this online commerce. OTT, players in the business, it has impacted the cinemas, TV channels, migration from, say, public sector to private sector. Private sector have boomed, and public sector have lost market share. They got marginalized in banking system. So I think the trend is very powerful. I think once you get the trend, then we have to figure out. So we have given examples of what all can happen. Technological advancement, that's one of the major source of big trend and big shift in business outcomes. Rise of AI, I don't know, this is a very new one, how exactly it is going to impact, and it's early days to say anything. Consumer preferences, rise of private banking, user industry demand, rise in steel and cement, demand for real estate boom, regulatory concerns, government subsidy on EVs. I mean, all these things we can keep going on, and this is only just an example of 10, 12 broad trends. There can be many more trends which can really, there are trends there can be very micro trends concerning only 2 or 3 businesses, but you have to spot the trend. Second, so impact of trend, any trend will have 2 impacts. Fundamentally, there are only 2 impacts of the trend. One is value migration. The trend leads to value migration. So value inflow into beneficiary sector and outflow from a losing sector. So like change in customer preference, banking, state-owned banks to private banks, telecom from fixed line to wireless, gems and jewelry from unorganized to organized, unorganized jewelry market to organized jewelry companies like Titan and whole lot of other companies. Change in competitive landscape like aviation, from full service airlines to complete discount. You see that in last 15 years, rise of Indigo. I mean, it's an amazing rise, 60% market share in just 12, 15 years. So these are the value migration examples. So either the change will create a value migration opportunity or value creation opportunity, like Google, Facebook, Indian chemical sectors. A lot of companies are creating, they are not benefiting from somebody else's business, but they are creating brand new businesses ground up. So, so that's the trend part of it. Then comes the endowment. Endowment is from where you start. The company, what the company has, whether it is a ownership group, quality of management, size of revenue, competitive production capacity. And I think one of the most important is the competitive edge. When the companies start small, whether they are 100 crore company, 200 company, the companies have that expertise. You know, the firm could be small, but the expertise could be very large. So when you have the competitive edge, when you find the companies with a competitive edge and a good management group, then you have the market share, you have the brand. A lot of small companies also have good brands. So from where you are starting, that is very important. Then the next is moves. So you have the trend, you have the starting point. Then what the company does, when the tailwind starts, like now in the capital market there is a tailwind. So what the company does to harness, you have the funnel, but how do you expand the funnel more so that you can get more and more of the wind into your bucket? So, so moves, corporate moves are the very important thing. Look at like the 4-5 ways of corporate moves are pragmatic M&A, dynamic reallocation of resources, strong capital expenditure, strength of productive program, improvement in differentiation, and change in management. A lot of companies, when they change the management, the fortunes change. So some of the example like Ultratech, you see methodically how they have built up by doing 4, 5, 6 big moves of M&A, going from 51 million tons to 127 million tons in last 8-10 years. So this is the perfect example of very good M&A acquisition and expanding your. Now the cement boom comes, they will, I mean, the kind of disproportionate benefit they will have compared to others. Dynamic reallocation. Angel One, it was an old broking house like ours, but they've changed to completely digital and they've put full bet onto their digital future. And you see what exactly is happening. Strong capital expenditure, Balkrishna Tires, again export story of 2000-2001. It is the most expensive tire company because they have been building up their capital base, the capacity, and catering to the client and getting global market share. Productive TVS Suzuki, we used to call it 2.5 kind of a two-wheeler company, half two-wheeler company, because they never could get more than 5-6% EBITDA. Today, they are at 11-12%. I think this is an amazing achievement of capital productivity change in last 5-7 years. Then Polycab, see the way they are building the brand, I think now it has become the most expensive company in the segment. They came from kind of behind and rode right through and is come on right on top of that particular industry segment. This is a classic case of, in 5 years, how you can ride the power curve. Britannia, and more recently CG Power, changed the management from Thapas to Murugappa Group. And of course, they were lucky, the capex cycle also changed. But from nowhere, now they are one of the, I think, $7-8 billion company and still counting. So combination of TEM drives the EP growth. I mean, when you have the endowment, trend, endowment, and the corporate action, that leads to your economic profit growth. Once economic profit growth is there, you need to buy them at reasonable price. So you need hockey stick valuations, and that comes from buying the stocks below 20p. There is no science of at what P multiple you can buy, but if you go by the past history of these companies, 54 companies which did more than 25% compounded, 70% of them were below 20p. I mean, starting from 4-5 P multiples, we've seen it was as much as, so average is about 14 P multiple and median is about 12 P multiple. So you have to buy very, very reasonably priced. There is no science to say whether you should buy at 7 P multiple or 14 P multiple or 20 P multiple. I would say you must also look at the P multiple of the market. Maybe in 2013 P multiple was 15. Today market P multiple is more like 22. So I would say that anything below 22 is other things being equal, being taken care of, any multiple below 22 or which is again more like 20 is a good multiple to start with. Because you have to look at for the provisioning, for the re-rating to happen. Because the single engine of only earnings growth will not be sufficient to give you a multi-bagger. You need the benefit of the earnings growth as well as the multiple growth. So this is all 54 multi-baggers or hockey stick companies in last 10 years. So coming to market outlook, I mean today markets are at a level where it is very interesting to see. I have never felt more, that is scary also. When you feel so confident from within, typically what is going to happen is just the other way around. So, but the markets have been kind of on long-term basis very bullish or has been growing at about 12-14%. But this time, we'll look at market outlook. In earnings data, valuation counters, demand supply, large, mid versus small cap, and what is my market view looking at all this data. So earnings data, so corporate profit to GDP, which is a broad number, which used to be at about 2%, 2.57% in 2003, when it laid the foundation for the biggest bull run. It went from 2.7 to 5.1 in 2008. That was the peak of corporate earnings. And then from there it started declining. And incidentally, in 2000, around COVID time, it again made a bottom at about 2.3%, corporate profit to GDP. And that has again shot up to 4% now. And right now, corporate profits are growing at about 15-17%, whereas the nominal GDP is growing at about 10%. So this number is still climbing upward. Second, expected higher trajectory for long bull run. So here, till about 2020, you see the stagnation in the Nifty EPS growth. And now, from 2022, from 2021 at 542, it shot up to 727. Current year was somewhat slow, 806. 23-24, this current year, it is expected to go up from 806 to 997, maybe $1,000. So this particular this is a year in which it will go from 806 to 997, which is more like 22% kind of growth. And I spoke to my head of research. He still thinks that this number will come. Typically, after half year, they used to bring it down. So they are quite confident about 1,000 rupees this year and 1140, 1150 next year. So we are into a very strong, earnings growth season. And valuation pointers are market cap to GDP, which is broad one again, is at 120%. Like our GDP is 300 lakh crores and market cap has crossed today, I'm sure today it has crossed 360 lakh crores. So we are at 1.21, I would say, and which is I would say, good level. I mean, it's a bullish level, and a lot of pessimism is already done and a lot of optimism is already captured. So at 1.2 times GDP, I think we are at fairly valued, I would say, and the only severe, I would say, is the earnings growth, which is at about 15 to 20%. Then you have the, what is the long-term range of Nifty P? Long-term range is about 22, last 10 years is about 22 average, and we are at 22. So we are kind of fully done up in terms of P multiple. Earnings to bond yield is average is about 0.69, higher the better, but now we are at 0.62. That also means that you are at a fair value. What is the demand? I think the real change is the FI and DI activity. And this is the thing which is driving the market. And that's what makes me think that we might be, we are in different kind of a bull market this time. So, so what is happening is FI behavior is unpredictable, as usual. But DI is broadly predictable. So what is happening? The DI is buying continuously, particularly after 2020. They are buying 12 billion they bought, and now then they bought 32 billion, and current year till date they bought 22 billion, and the activity is picking up. So they are buying because there is a massive rise of retail. We'll talk about it. But FIs, they have also been more or less buying, except for in 22, they sold $17 billion. And now in the current year, they are making it up. But they sold at about 17, 18,000, and now they are coming at about 2,000, 20,000 or 21,000. So this is what is the real difference this time compared to other times in the last 20 years. So what is happening is there is almost 2.5 to 3 million retail accounts, demat accounts are opened up, and that has shot up the total participation from 40 million in 2020 to 133 million as of November end. And this 2.5, 3 million is continuing. And I think there's a lot of juice even today. My sense is we are headed for 250 million accounts in next 4 to 5 years. So the base of the market, I don't know where it will stop. When it stops, we'll see when it stops. But right now, the influx from the retail side is happening. So what is happening is, because market performance is there, the guys who are in the market, they are allocating more, and the new guys are coming 100,000 per day. So this is a very, look at the performance of the average daily turnover of the retail segment of the market, from literally nothing, maybe 2, 3 lakhs, 5 lakhs initially. Now it is about 140 lakh crores per day of the retail turnover is there. And it is still climbing very rapidly. So I think the DI activity, DI's flow is coming in SIPs and in very predictable form, but FIs remain unpredictable. But when they also want to buy, then what happens? So there are demand is coming from FI, DI and retail. So retail and DI both are buying, because DI is nothing but retail flow. So DI and retail are buying. FIs also have turned buyers. So this entire thing is buying. The sellers are companies. Either they are diluting for the follow-on equities, or their unlisted companies are coming listed. So IPOs are happening, and follow-on offerings are happening. And promoters are having great time. Promoters are selling blocks left, right and center. So the supply, so 50% of the market is demand side, and 50% of the market is on supply side. So I think we have enough supply in the pipeline. So don't worry. I think markets, if it tries to do unreasonable things, I think enough supply will come. So I think it will keep the market expanding, and I hope markets don't go out of sync. So large, mid, and small caps. So this is a 10-year chart of all the three indices. So typically till 2020, somehow aage piche karke they used to merge, and their returns used to be like 20-year return. Even today is 15% compounded for all the three indices if you do 20 years. But if you do 10 years, what has happened is that now large cap is at 3.26 times, mid cap is at 4.4 times, and small cap is at 5.59 times. This is what has happened. Now what it does is that when you do a ratio between mid cap and large cap, just to draw some kind of what has been the past behavior, future can always be different. So here we have seen that the ratio used to be about 1.6, 1.7x, and at the peak it was 2. Now it is 2.1, 2.2. So clearly mid cap has gone little off the chart. The ratio needs to be corrected. Now ratio will get corrected two ways. One is either mid cap falls or large cap goes up. Quite possible large cap may do better as the FIs come in next 10-15 months. Even today, if you see today's move, large cap did better than small cap. So this can be a trend where ratio needs to be corrected for sure. I mean, these things, they do work. It takes time, but they will definitely get corrected. In small caps, luckily, despite so much of move, small cap is still at about 0.61 or 0.62 of the large cap. So excesses are not as high as mid cap, but there also now we are getting into a range which is kind of a little more expensive. So my sense is at market cap to GDP of 120%, we are fairly valued. At nominal GDP growth rate of 10%, Nifty EPS is likely to grow at about 15%. Very strong, predictable retail participation will play a major role in market behavior. And the best is yet to come, because this flow is very predictable, and if by chance FIs also decide to buy, I think we are going to see a lot of action in the market. So conclusions, economic profit is a superior metric to accounting profit to understand true profitability of a company. Trend independent moves is a sound strategy for companies to move up the economic profit curve. This economic power curve is quite a sight. I mean, when I saw it first time, I couldn't believe it happens only in America, I thought. But when we do the chart here, it is exactly like that in India also. Successful 10 companies bought at reasonable price improve the chances of hockey stick returns. Mid and small caps are the favorite place to deliver hockey stick returns. After 2 decades of sustained decline, PSU stocks are on a comeback. For Indian equities, the best is yet to come. This is what I think. And so my sense is, don't bet against India. Welcome to the bull market. Thank you.
Six minutes. I'll 5 minutes. Bring you back in 2 minutes. Thank you, Raamdeo ji. It was quite remarkable that every year, you end up coming with new insights and new themes for all of us to think about. Everybody out here, or we meet investors, everybody wants jockey stick returns, everybody wants multi-baggers. So now we have some science through this wealth creation study as to how we can get to the multi-baggers or companies which can give hockey stick returns. So thank you for that. So friends, of course, this year, a very influential global personality in the world of investing, Mr. Charlie Munger, partner of Warren Buffett at Berkshire Hathaway, passed away. And we thought that this time around in the wealth creation study event, we would do an entire session to pay tribute to Mr. Munger. We all know that he was partner of Warren Buffett and very, very influential personality to an extent that he made Buffett think differently about how he used to think about investing in the past. So, so we have created this special panel today with a lot of special guests who would discuss about Mr. Charlie Munger and his wit and wisdom. So this will really be a very, very interesting panel session, and I'm sure a lot of new and rich insights will come to all of us. So in this panel, to begin with, we have a very distinguished personality, Ms. Latha Venkatesh, who's the Executive Director at CNBC TV 18, to moderate the panel. She has keen interest in Indian markets, fixed income markets, as well as global markets. So extremely happy and pleasure welcoming you, ma'am. If you can come up. So to co-moderate this panel discussion, again we have Mr. Ramesh Damani, who's the chairman of Avenue Supermarts, and he's the managing director of Ramesh S. Damani Finance Private Limited, who are the members of BSE. He will again bring a lot of interesting questions to our panelists. So please welcome Mr. Ramesh Damani. So our first panelist is Mr. Raamdeo Agrawal himself. So sir, if we can have you back again on the stage. So he's coming. Second panelist, Mr. Sanjoy Bhattacharyya, whom Raamdeo ji always says he's guru of Raamdeo ji, Sanjoy ji. So he's the managing partner of Fortuna Capital. He's a value investor. Apart from investing, he's passionate about bridge and visual arts. Thank you, sir, for coming, and please join us on the panel. So while they're coming, our third panelist is again a very special guest from US. He will be joining us over Zoom. So we have the digital technology. We will be joined by Mohnish Pabrai, who's the third panelist. He's the managing partner of Pabrai Investment Funds, also founder and CEO of Dhando Funds. And also we all know that he has been a close follower of Charlie Munger. So we are about to connect with him. Is he online? So he'll take 2 minutes. So shall we start? Okay, yeah. So we have a special video made as a tribute to Charlie Munger. So can we play the video, please?
People don't seem to get that point. You have any idea why, Charlie?
Warren, if people weren't so often wrong, we wouldn't be so rich. Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
Yeah, it's not that much fun to buy a business where you really hope this sucker liquidates before it goes broke.
I like cryptocurrencies a lot less than you do. To me, it's just dementia. Professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out. So, no, I'm optimistic about life. If I can be optimistic when I'm nearly dead, surely the rest of you can handle a little inflation. A director getting $150,000 a year from a company who needs it is not an independent director.
They're looking for chihuahuas and not Great Danes. Yeah. And I hope I'm not insulting any of my friends that are on comp committees.
You're insulting the dogs.
I've listened to so many nonsensical cost of capital discussions that,
I've never heard an intelligent one.
yeah, Charlie's big on lowering expectations.
Absolutely. That's the way I got married. My wife lowered her expectations. Sure, there are a lot of things in life way more important than wealth. All that said, some people do get confused. I play golf with a man. He says, what good is health? You can't buy money with it. It's not that great a business as a business, casualty insurance. It's a tough game. There are temptations to be stupid in it. It's like banking.
Great, superb. So, do we have Mohnish online? Rohini? You're online. Yes, sir. Good evening. So you're online. I think, Latha, you can take it forward. Yeah.
I am, yes.
Yes. Hi, Mohnish. Good morning.
How's it going?
Yeah, we're just waiting for you.
We're good to go.
Yeah.
Thank you. Okay, so once again, welcome all of you to this very special chat, tribute to Charlie Munger, and let's very importantly add his wit and wisdom. Very clearly the title is saying that he is not just an investing colossus. He is a colossus. We ought to get that. I mean, just a read of his biography. Started as helping his grandfather in his grocery store, was a meteorological assistant to the US Army in the Second World War, a qualified architect, trained as a lawyer, and then the investment genius is just the icing on the cake. So clearly a many-splendored man. And therefore, my thanks to Motilal Oswal and to Raamdeo Agrawal. Every year they do produce a gem of an idea in their wealth creation study, but to defer to the investing genius and say that we'll rather learn lessons from him this year rather than a panel on their work is an excellent idea, an amazing one. And thank you for that. Well, as was just announced, we are the co-moderators, but I think that is a delusion that has been sold to Mr. Damani. As far as I'm concerned, he is a fellow, he is a panelist. And I'll be directing as many questions to Mr. Damani as to Mr. Bhattacharyya, to Mohnish, Pabrai, and Raamdeo Agrawal. But, you know, just a word on the panelists. Mr. Damani, I'll defer to you. I think you know their Mungerisms much better than I do. So please go ahead.
Thank you, Latha. Thank you, Raamdeo, for inviting me. You know, one of Munger's heroes was a guy called Benjamin Franklin. And he used to quote, he said, well done is better than well said. And Munger not only spoke well, did well, but lived well. An extraordinary life. And Charlie was, of course, known for his multidisciplinary mind. Munger's life straddled 2 centuries. And his insights from the study of psychology, economics, physics, biology, history, and as you said, even architecture are astounding. When asked the secret of his success, he said, I'm rational. So here to discuss his wit, wisdom, and life's work, I'm joined by a panel devoted to understanding him. Of course, Mohnish joins us all the way from the States somewhere. Hi, Mohnish. Thank you for joining us so much.
Great to be here.
Yeah, I'm joined by Sanjoy Bhattacharyya. A lot of people call him a professor. Some people call him guru. But I call him apne Mumbai ka Munger. And then I'm joined, of course, by our very own Raamdeo Agrawal, whom I like to call apna Bharat ka Buffett. Bharat ka Buffett. So thank you all for joining us. Yeah, the vice chairman, Chalo, we'll take care of that. But thank you. But before we start, I just want to see how much the audience knows about Munger. So I've got a small rapid fire for them. So let's see how they do.
Please, go ahead.
So I'm going to ask you some questions and you can raise your hands, and I would assume my fellow panelists and my son here knows all the answers, but let's see how good the crowd is on Munger. Okay. Sometime in the 80s, Buffett bought Munger. When Buffett bought his first corporate jet, Munger called him and they named the jet what? Your choices are Berkshire 1. Please raise your hand, those who think it was called Berkshire 1. Okay. The Indefensible. Who called it the Indefensible? Okay, a few hands. And the third one, Capitalist Tool. Well, the correct answer is indefensible, because Munger thought that the purchase was indefensible. And to Munger's honor, he used to travel even in his late 90s by economy with a book. Correct, Sanjoy? According to Charlie Munger, one investment that he still regrets is, the choices are A, Fannie Mae. Raise your hands. B, Eastman Kodak. C, Alibaba. Yeah, again, I mean, this is not a very fluent audience, but it's Alibaba. Actually, in the last interview, he said he regretted buying Alibaba the most. Okay, here's one. Buffett and Munger bought See's Candies in the 1970s for paying $25 million, one of the most iconic trades that they did out there. And Buffett as Munger have often waxed about how much cash See's Candies generated. How much cash do you think See's Candies generated over the next 50 years for them? Is it A, 25 million? Is it B, 100 million? Is it C, 2 billion? Is it D, 25 billion? It's C. He's right, of course. He knows everything. I called him a professor for good measure, you know. So it is, of course, 2 billion plus that was generated from a single $25 million investment. And what Buffett and Munger have taught us and generations of investors is that a business that throws out cash and doesn't require capex is worth its weight in gold. And they always give this example of See's Candies, of how much it does. Munger was in one avatar of his life, Latha, a real estate developer. Yeah, he also did real estate. And the key to him, according to Munger, to generating more money from real estate was what? A, bigger square footages of homes. 2, larger kitchens in the homes. Or 3, lush landscaping. How many of you feel it was the first one? Bigger square footage would generate more revenue. How many was B, bigger kitchens? Arjun, you're wrong. And how about lush landscaping? He used to say lush landscaping will give you 3 times the return of that.
He had another one on this, which is phenomenal, because I think...
Mike.
He had another interesting thought on this, and I'm sure Mohnish would speak about it at some point. You know, a few years before he passed, he made, I think, the University of Southern California, if I'm not wrong, an offer that he would grant them $100 million to make dormitories.
Correct.
But there was one condition. He said the dormitories cannot have windows. And so people were stunned. They said, what kind of guy is this? And his logic was very fascinating. He said, if you don't have windows, people will come out of their rooms to meet each other. So there'll be much better social bonding.
And he learned that from basically the cruise ships, you know, when people, you know, mingle and single out there. Great. A company that Munger admired the most, all right, in his life. And I'll just share a joke with you because it'll be kind of fun to hear this joke. So Buffett and Munger are going on a plane somewhere and it's hijacked. And the hijacker says, okay, one last wish, what do you want? So Munger says, well, I want to give my presentation on Costco one more time and speak about the virtues of the retail business that Costco does. And they ask Buffett, what is your last wish? So he says, shoot me first. So Buffett was clearly the biggest admirer. I was going to say Apple, Coke, Washington Post, but I given the answer, it was Costco. There's a famous talk Munger gave in the 1980s where he projected by 2034 what would be the Coke's market cap. What should be Coke's market cap? He said, taking back 150 years and using only the mental models that he was famous for, he projected the market cap of Coke. In your opinion, what would it be? Would it be A, $2 trillion? Raise your hands if you think it's $2 trillion. B, $200 billion. C, the company would be bankrupt by 2034. Come on, you got to get one of those answers, guys.
2 trillion.
Too hard to determine. Okay, Latha is absolutely right. No wonder she's the economics editor also. $2 trillion. He actually projected out $2 trillion. And he said there were 8 billion people, 4 billion servings, 8 billion servings a day. Multiply that, make 4 cents a serving. It comes to $115 billion profit, right, Sanjoy? That gives a multiple of 20, becomes a $2 trillion company. Okay. Under Warren Buffett and Charlie Munger, Berkshire Hathaway has roughly returned to its shareholders what returns? Is it a 10-bagger? Raise your hands if you think it's a 10-bagger. A 100-bagger? 100-bagger, guys. Hockey stick. No? 1,000-bagger?
10.
10? Latha, I'm disappointed in you. 10-bagger for Berkshire Hathaway? We won't be talking about them. It's been a 20,000-bagger or 2 million percentage return for Berkshire during their life. In fact, someone calculated that if Berkshire stock fell 95% or I think 99% from the price it's today, they would still beat the S&P. That's how lucrative it has been. Okay, final thing, in his last days.
Ramesh, can I add to that?
Yeah.
This is one of Raamdeo's favorite themes.
Mike.
This is one of Raamdeo's favorite themes. And in a sense, a lot of Mr. Munger's life is exemplified and best understood in terms of the power of compounding. So I think if you ask people and you just told them the absolute number of times it had multiplied, I think it would be interesting to ask them at what percent it compounded over that period of time, from 1974, when he first acquired Berkshire, complete control, till today.
Give them three choices. Ask them.
Okay, the first answer is 16%. The next one is 20.5%. And the last one is 26%. Yeah, this is more common. Everyone seems to know this.
20.5, they figured what the answer was.
A bit too precise, so it should be correct.
Okay, what was Munger's? This is the last question before I turn it over back to Latha. In his last years of his life, Munger used to enjoy watching a situation comedy, a comedy series on television. Which one did he watch? Was it The Friends? Was it The Crown? Or Sanjoy, was it Seinfeld?
I'm not 100% sure about this, but I think it was The Crown.
Okay. How many people say The Crown? Well, I'm glad I got the professor on at least 1 point. It's actually the Seinfeld. That's what he said to Becky Quick. That he enjoys watching the Seinfeld. Great. Latha, thank you.
But at least we are glad he watched comedies. There's something I can say I have common with him. All right. Well, actually, we have people here who have, Mohnish Pabrai and Sanjoy Bhattacharyya, who have actually met and spoken to him, and Mr. Damani and
The
Raamdeo.
maximum is Raamdeo.
Okay.
Though Mohnish started the lunch idea with Mr. Buffett, I think the number of times
he visited,
who doesn't live in the United States, I should put a qualification. Among the people who don't live in the United States, the guy who's met him the most is Raamdeo.
Sanjay, Mr. Bhattacharya, you
Yeah,
have.
sorry. Yeah.
Okay, no, the question really is to you. What was your reaction when you first met him? And what are the life lessons that you drew from the times you personally met him?
I think I was very impressed by the fact that he spoke so little. I thought that was the hallmark of true wisdom. You know, Buffett kept on chirping all the time. And once in a while, he'd ask Charlie to say something. Charlie would say nothing to add, which I thought was a sign of a guy who was really secure. So he never used to sort of use even one unnecessary word in communicating. The second thing that I loved about him, and in a sense it was an inspiration for me, was this desire to try to learn constantly and to improve yourself constantly and to read. As he said, many people thought he was, a book with two legs sticking out. So I'm nowhere there, but I think that idea is inspirational, that you should try to constantly learn and improve yourself every day, a wee bit even. And one of the best ways of doing that is by reading. So these are the two things that I took away.
Absolutely. I mean, I think the lesson that every day when you go to bed, you have learned a little more than what you were when you got up in the morning is, I think, a great lesson, something you can remind yourself. But
and the third thing, sorry, Latha,
yes,
if
sure.
I may. And, he was an investor.
Third, fourth, fifth is fine.
No, the third thing which it really resonates with me personally is he was an investment genius, he was an intellectual colossus, apart from his, independently, I'd say, if he hadn't been an investor, he would still have been supremely gifted in doing whatever he did. But the thing, and he said this in one of his quotable quotes, I forget the exact quote, but he said one of the best things you can do in your life is to help other people to get to know more and to do better, which I thought was truly, truly remarkable. In fact, it reflects the character of the man. If there's one thing about Mr. Munger that people often don't take note of, is that he was such an outstanding human being in terms of his character. It is truly rare to find people who have such incredible character. Blunt, forthright, honest, and
giving.
And giving, that's right.
Both
absolutely.
Money and mind.
That's right. Absolutely.
Yeah, that's the stunning quality. Mohnish Pabrai, you are in that fortunate position as the last person to have in many people I know, to have actually had lunch with him. Tell us about that day. Was there something outstanding, some anecdote that still keeps coming to you?
Well, the what was my last dinner, I didn't know it would be my last dinner with Charlie, was exactly 1 month before he passed away. And we had a nice home friendship, very unlikely. I still don't fully understand why he wanted to be friends, but that went on for like more than 14 years. And in the 14 years, I used to play bridge with him quite a bit and probably meet him 5, 6 times a year at his home for dinner and so on. And I had never really imposed on Charlie, right? So I would just be in reactive mode in the sense that he would say, come over for dinner, and I'd say, okay. But I never like asked him, can we meet or whatever. And the only time I did that was for that last meeting. I felt somehow that I wanted to see him. So I reached out and I said, can we meet? He said, yeah, so on a Saturday I went to LA and it was just me and him. So it was just a one-on-one wonderful evening. And, the thing is that Charlie was clearly dealing with a number of health issues. He said, that quote to me was, there's a lot wrong with me. And I had brought him some stuff to read, and his assistant actually told me that, listen, don't give him anything to read below 24 font size. So basically he was almost blind, but never complained. So actually the stuff I gave him to read, 24 font is really large, and so it was printed in a really large font. But basically I asked him, Charlie, you lost so many things. Golf went away, bridge went away, going to the office went away, driving went away, so many things went away, right? So I said, what bothers you? What bothers you about the way you are? And he really wasn't, never a complainer, right? So he said, the only thing I wish were better were my eyes, right? He had one eye that he was not blind in. And reading was really important to him. So even when reading was almost gone, not a complainer, right? And so basically, the key thing about Charlie was to soldier on, right? So his whole mantra was to just keep going. Almost every time I met him, at least 20-30 minutes would go talking about Costco. That was Costco was his, besides Berkshire, was his love in life. And all kinds of different things would come up about Costco. He would almost always be in a Costco flannel shirt, which you can buy for like $10. And I'd say the biggest lessons I learned from Charlie is not so much what he said, it's observing him. Observing him with the way he's interacting with his kids, his grandkids, his sons and daughter-in-laws, and so on. Like once a week, I think every Friday, he'd have a Zoom call with all his grandkids. Whoever could make it, they would join the call. And just a very warm person, very different from the persona we used to see in the Berkshire Hathaway meetings. A very warm, caring person.
Okay. It's almost coming alive, the way you say. But just occurred to me, what would be the Costco of our times, if you have to pick? I must insist, you must remember
like
about
the company Ramesh chairs, Avenue Supermarts in India. I mean, if you're looking for the Indian equivalent of Costco, though I must say, there are some important differences between Costco and Avenue Supermarts, which I'm sure, again, between Mohnish and Ramesh, they'd be the better people to speak about it.
I can say
Ramesh,
something. Nothing to add.
You can't escape from this. What's your Costco?
I think that would require a much
Insist on
superior
nothing
IQ.
I'm just asking you to think on your feet. Obviously, if you thought through, you will have different answers. But
no,
Raamdeo, you too.
I think Costco is a unique model, and I think I remember Munger quoting once, and he was actually in love with Amazon too. He thought Jeff Bezos did a great job, but he actually said in print somewhere that Amazon should fear Costco and not the other way around. So that tells you a little bit about how much he loved that company.
Raamdeo, you want to try this question?
Yeah, without any confusion, it is the Avenue Supermart. I mean, closest to that. As a company, I'm saying, the business model, you know. Yeah.
In the same sector. Mohnish, Pabrai?
Yeah, I discussed this a bit with R.K. Damani, and I think a lot of the inspiration of DMart is really very heavily influenced by Walmart and Costco. So
Okay.
I think it's a combination of those two that a lot of the model came from, and those are both amazing businesses. And we've seen obviously tremendous execution at DMart, and actually, in fact, one of the areas where Costco and Walmart differ a lot is in paying up for great real estate. And Costco always wanted to put their stores closer to where there were affluent population centers and so on. And Walmart was always looking for the cheapest store, thinking that people will drive to wherever they need to go to get to them. And I think DMart took a lot of that playbook from Costco. So it's actually very, very wonderful to see some of the spirit of Costco in Mumbai and India and doing so well.
Okay. Well, actually, I thought somebody might even say Zomato, but that discussion for another day. Raamdeo, there are many lessons we've got from, or we hear from Charlie Munger. Companies with a big moat, companies which fools can run. What's your best lesson, which you have lived?
I would say two of them. One, that Buffett's biggest mistake is corrected. In fact, he changed Buffett. He bought his biggest mistake was buying Berkshire Hathaway, because he was student of Graham, where you needed to buy cheapest possible stock, nets they call it. So that's what, once he met, I think after buying the stock, he met Charlie, and Charlie changed his mind. And he said, buy wonderful business at reasonable price rather than fair business at a very low price. So that change actually brought him to buying, blue chip stamps. And Coke. Then in there they bought Seas Candy. Then they bought Coke and everything, all
American
the franchises.
Express, yeah.
So we learned from them. First time I learned that return on equity is more important, the franchise value is very important. So the quality culture came because of him. Because initially, Buffett was a brand equity. I mean, like, we give all the credit to Buffett. But Buffett himself has gone and said that it is architected. Berkshire Hathaway itself is architected by Munger. They have executed the plan. So that's what is the biggest learning. Second one is about the compounding. He said, I learned about compounding in 91. But really what he said, which meant actually a lot, even today, is that it's actually heart and soul of understanding compounding is to first understand. And second is what it takes to engender it.
Which is patience.
Yes. So, patience and what the size of effort. Say like you grow at 25%, in 10th year, you have to go from 8 to 10. In 20 years, you have to go from, say if you have to go to 1,000, you have to go from 1,500 to, or 1,600 to 2,000. So, you have to go from 800 to 1,000. So your effort in that year is 200 times or 2,000 times a student's effort. So when he has done 20,000 times, you imagine at 15 or 20%, what is his last few years' effort?
Last mile effort.
Yeah, so what it takes to engender that. So business model, the size of opportunity, the management depth, you have to really think through what is going to happen, not in next 1 or 2, 3, 4 years. Can this business actually compound at 25% or 20% after 20 years, 30 years? So there are very few business models which offer that opportunity. So, these two things stuck with me big time.
What about you, Mr. Damani?
Latha, we've all learned.
You've spoken in a previous wealth creation study about circle of competence. Is that a big lesson that
Yes.
you do where you are competent?
Yeah, of course, it's extremely important. According to Buffett, not only should you know your circle of competence, you should know the edge of it. So famously, they didn't buy Microsoft despite being pal with Bill Gates. But the thing that astonished me when I learned about Munger is illustrated in terms of a story. He said he was the chairman of Daily Journal, which had like a $10 million balance. And for 40 years, he read the financial paper Barron's and did nothing. And then one day he found a stock in there, which he thought was a no-brainer. So he went and bought the equity and the debt of that company. For namesake, it was called Tenneco. And he put $10 million into it. All of it in one sweep put. So he waited 20 years before he got that opportunity. When he got it, he put all in. He didn't buy 10,000 shares or 20,000 shares. He put all of it in there. He took that $10 million, it went up to $80 million or something in that neighborhood. He sold that stock. He gave it to his protege called Li Lu, who turned it to $400 million. So here he took $10 million and made it into $400 million just through waiting for the right investment opportunity. That mediocre opportunities are not, I unfortunately do that. You bet on mediocre opportunities, you feel you're missing the bus. But as Sanjoy said, that intellectual confidence in yourself, to wait for the right opportunity, strike, and then back up the truck when to buy it. These are almost immortal lessons.
Well, actually, if you can develop that point, Mr. Bhattacharya, was it Buffett or Munger who said that you should do only 20 trading punches in your life? Buffett. I mean, that means only 20 buys. That means waiting for opportunities of 1 a year or 1 in 2 years if you live a very long life. Is that kind of patience?
I think that's part of the problem in India. We are looking for a multi-bagger every day. It's a serious problem with the evolution of Indian equity markets. Everyone spends most of their waking hours trying to find a new multi-bagger. I find this absolutely amazing and contradictory. It's simply not possible because it belies the faith in compounding. No one sets out to buy a multi-bagger. I don't know why people don't get this. When you sit down to look at a business, the lesson you learn from Charlie is that you focus on the business and how well you understand it. And the point Ramesh made, I think Mohnish made, is that if you understand it really well, you can actually run it. The level of your understanding of a business is demonstrated by your ability to actually physically hands-on run that business. You know, the ability to buy 100% of a company as opposed to small fractions of it
demonstrates that confidence.
If you couldn't run it, you wouldn't buy 100% of it.
Yeah, and also to add another point to the story, he made $400 million from those two trades. That, in effect, when he died, was almost 25% of his net worth.
Yeah,
so
right.
he was $2.5 billion and $400 million came from that. Astonishing stat.
Yeah. Okay. And for a guy who was very bullish on America, and this is, I think, a reflection again of how of his open-mindedness and his willing to constantly keep on adding to his treasure trove of, investing acumen. I think, and Mohnish would be the perfect guy to speak about this. He was greatly, I don't know, influenced is the right word, but he was very greatly sort of impressed by Li. Or Li Lu. I don't know how you pronounce his name.
He might have met, Mohnish must have met Lilu.
Yeah, I'm sure he has.
Or he might have also given some money to him.
Absolutely. I don't know about that, but I'm sure Mohnish knows him very well. Okay. But the thing is, Buffett and Munger both said that why do you need to invest outside America? You need to, American companies invest in other countries, so why do we need to go and make So I think Li persuaded them for the first time, and it's a reflection of their open-mindedness, their willingness to listen, their willingness to recognize the huge differences that exist, and he embraced that wholeheartedly.
Fair point. Fair point. Well, actually, Mohnish, you're at a disadvantage because you're not jumping into the conversation. It's between us. So I invite you to jump into, add to any of the points made by Raamdeo, Mr. Damani, and Mr. Bhattacharya. But my separate question to you is exactly this. I mean, inspired by what Mr. Bhattacharya said, he was a China bull, seemed to have been an India bear. Did that come up in your conversations with him? Did he ever regret it?
Oh yeah, it came up many, many times. And so I'll just quickly share 3 things that I think some of your viewers and people in the audience might find interesting. Is one of the biggest takeaways I got from actually Charlie and to some extent from Warren is that Charlie never looked back. So every time I would meet him, I would bring up, I said, look, Charlie, the body of work and the things you've done, the things you did for Berkshire, the things you've done for, Huntington Library, all these different things you've done. And he would just brush it off. He wasn't interested in talking about that. And what he would always have all his energy focused on was the problem at hand. So he never looked back. I learned a lot of lessons in that. A lot of us, we may have gone to good schools, we have worked at great places, we've built a business, whatever, and we look back and say, oh, this is good and that is good. Charlie never did that. He basically, so I would meet him, and one time he was struggling with the succession at Daily Journal. He needed to find a CEO. And the entire evening he was just, talking about that. So all his energy was focused on the problem at hand. He got wind that there was a very large piece of real estate in Central California near the University of California, Santa Barbara, called Doheny Ranch. And Doheny Ranch is about 1,800 acres. It has about close to 2 miles of ocean front, Central California. It is worth in the billions. It's several billion. The family wanted to sell it. And Charlie got wind of it. And in about 3 days, he got a deal done where he convinced the family to sell Doheny Ranch to him for $73 million. Okay, something that was worth probably north of 5 or 7 billion or 10 billion. Couldn't even put a price on it. It's just amazing real estate. And he basically told the family, listen, you sell it to me for 73 million. One day after I buy it, I will donate it to the University of California, Santa Barbara. If you take a tram from that 1,800 acres to the UCSB campus, it's an 8-minute tram ride. So all these campuses, Harvard and MIT and UC Berkeley, UCLA, etc., they have severe real estate problems. They are very landlocked. They can't grow. A lot of housing issues. Basically, what he did was, so the family, he convinced the family. He gave it to UCSB. The 1,800 acres is good for about 400 or 500 years of growth for UCSB. And the way he convinced the family was, he said, look, in California, the Coastal Commission and all these bodies, you will spend 100 years and they will not let you build anything on it. But if we give it to the university will be able to build on it. Nobody will object to the university building. And the family got it. So this whole deal took place in 3 days, right? And I met Charlie. I said, Charlie, of all the things you've done, this is huge. This is massive, right?
Yeah.
Brushed it off. Like no interest in talking about it. Never ever, most people don't even know about it. And because it was for him, his perspective was done. There's no point talking about it. Let's move to the next problem. And so I think that kind of approach of looking forward and not looking back was tremendous. I think very early when I met him, the first time I met him was in 2009, and I think in second meeting or something, he told me that he introduced me to Li Lu, and he said, I want both of you to promise me something. We both met him together. Mm-hmm. He said, I need both of you to meet once a month for lunch. No agenda, just meet for lunch, right? So I told Charlie, I said, Charlie, if Li Lu wants to waste time with me, I don't have a problem, okay? And so we used to, Li Lu and I used to meet. I mean, he now moved to Seattle and I'm in Austin. So our monthly lunches have gone by the wayside, but we still, at least 2-3 times a year we get together. Those lunches used to take place at Din Tai Fung, which is one of my favorite restaurants in California. And it was just wonderful. And I had a lot of discussions with Charlie about Li Lu. So I asked him, I said, Charlie, look, you meet this Chinese guy, cold, you don't know this guy. Yeah. And a few weeks after you meet him, you give him all this money to manage, right? So I said, where does that come from? Like I said, how are you able to figure out that he's extraordinary? And his answer was, Mohnish, there's nothing to figure out. Look at the track record. He said, I just looked. So when Lilu came to the United States, he was a wanted man in China. They wanted to actually imprison him for life. He was one of the leaders of Tiananmen Square. He did 3 simultaneous degrees at Columbia, undergraduate degree, MBA, and a law degree. Finished all 3 in 3 years, nearly at the top of his class. Came to the US with no English and finished. He was on student loans for his entire education, and the float on the student loans, so like for example, he has to pay, $20,000 or something in tuition. They would give it to him at the beginning of the year. And he used to invest the money before it actually needed to be paid. When he finished at Columbia, he had more than $1 million. And of course, in addition to that, he had, finished a degree and such. So Charlie said it was just a no-brainer. And I had a lot of wonderful insights and learnings from Charlie. So that's the other thing.
The India view, if you please.
He always went for the no-brainers, right? So Charlie was someone who was very patient. And almost every time, probably last few years, every time I meet him, he'd moan and groan saying, oh, we can't find anything to buy. Berkshire's cash is building up, this and that. And I say, Charlie, you guys always complain about this, and then in 4 or 5 years, some big elephant will show up and you guys will take care of it. So I know that you keep moaning and groaning and keep looking at things, but it'll work out. But I think some of these things where, you don't look back, never want to take credit for anything. I was not bothered about any credit or any accolades to him. Most recent interview, I think, with Jason Zweig told him, what would you like on your gravestone in 8 words or less? And, he said, I tried to be useful. Okay, that's 5 words. Okay, I tried to be useful. And he didn't even hesitate for 2 seconds. And then he also asked him, who are you most grateful to? In life, Charlie, who are you most grateful to? He said, the first husband of my second wife. Okay, and he said that I only needed to be slightly better than that guy, and I had the unlimited love of this amazing woman because she contrasted me with him. So he said that I'm eternally grateful to that guy, and again, just very, very quick, great mind. And so many times I'd bring up, we have a foundation in India, Dakshin. I have all these fork in the road issues. He'd never been to India. While I'm mumbling and fumbling what I'm trying to ask, he's already answered the question. And after he answered the question, then I'm thinking, why didn't I think of that? It's so obvious.
But
so
still,
everything would appear obvious after he said it.
Oh, absolutely. But any word on India? Any conversations?
Yeah, I think his concern on India was the bureaucracy. So, Churchill used to say, democracy is the worst system except for all the others. So we see that contrast between China and India. China wants to build a 1,000-mile road or 1,000-mile railroad. It'll just be built. Whatever's in the path will be just taken out. In India, we have due process. We have a lot of special interest groups and all these things, and those projects will take forever. We struggle with things in India, right? And so he recognized that. At the same time, he recognized that India was a place just like China where there were natural entrepreneurs. But his in balancing between, what were the positives and what were the negatives, he saw some of the negatives with the British bureaucracy that had been left behind and all of that. So his perspective was, well, he only wants no-brainers. India, even I think, requires a lot of brain power. So when I look at India, like even if you look at Motilal's study, there are exceptional businesses in India, exceptional managers, but they are exceptional investors too. And so it's not easy to find a 100-bagger in India. That's far from easy.
Okay. Well, the other question that occurred to me, Mr. Bhattacharya, did he ever discuss macros? Or was he all in stocks? No macro at all.
I think Buffett echoed this at some point. He said the only thing you need to really think about, and Mr. Munger supported this, was you need to know the direction of interest rates, which is driven by inflation. He said, but apart from that, once in a while, if I know what's going on with interest rates, he didn't seem to think that it mattered very much. He was really focused on the heart and soul of what he owned. I also want to just make a quick comment for, I think, our audience. And in a sense, I think subconsciously, I don't know when Mohnish started it, but this is how he might have been influenced personally by Munger. This Dakshina Foundation, it is truly exceptional. And I would urge everyone to take a look at it. The kind of work it's doing and its agenda. It's very un-Indian, and it's, to my mind, ironic that an Indian sitting in the US is doing it here. So, congratulations, Mohnish, and I think everyone should take a look at it.
I'll add to that, it's God's work what he's doing. He's exceptional. They take people from the absolute margins of society and turn them into IIT and IIM graduates. I mean, it's exceptional work.
I think a round of applause is called for. I hope the message has hit home.
There's one more thing. It's run exceptionally well. There are few businesses which are run as well as the Dakshina Foundation.
That's very good to hear, sir. Very good to hear.
One of the interesting things is that there are two people on the stage there, Latha and Raamdeo, who've been to the Charles T. Munger Hall that Dakshina has in Bangalore. I encourage all of you to go there. I would just say this, that if there wasn't a Warren Buffett or a Charlie Munger, there wouldn't be a Dakshina. I did not grow up in India with a very strong ethos, or any ethos actually for that matter, on giving back. The focus would be take care of your family, take care of your loved ones, and that was the end of that, and maybe a few people around you. And it was really when I studied Warren and Charlie that it dawned on me that there was a greater sense of purpose that one could attach. And actually both of them were very useful. Both of them read every Dakshina annual report, cover to cover. Last time I went to see Charlie, the last two Dakshina annual reports were on his table. So many times he would ask me a lot of questions about different things about Dakshina, what Dakshina was doing. And even Warren would ask me questions about that. So they had tremendous influence. They continue to have a tremendous influence on Dakshina. It's been wonderful.
I remember that Mohnish introduced me to so many of their staff, and he knew their families and how many of them had, tied it over to great heights. It was a pleasure. The post-interview getting to know Dakshina and the sub-staff was a really satisfying experience, a glorious experience. Let me just don my journalist cap for 1 second before I hand it over to you to ask the more difficult questions. Mr. Bhattacharya, do you think that India is in a good spot now? The way Mr. Raamdeo presented it. Do you think demographic trends, even tax to GDP is increasing year after year? Do you think there's something big that we are on, or are we over-marketing ourselves to ourselves?
You put it very well, Latha. That's wonderfully put. That last phrase is a wonderful illustration of how you can put something really tricky in a nice way. And you've done what a lot of people do to me. You've put me on the spot. I must say this. I think, this is an incredible country. It has amazing capabilities across a very wide spectrum of activity, entrepreneurial capabilities, and a huge bunch of things. But I think the two, and if you look at Charlie, and try to ask yourself, how would Charlie have looked at India? I think that's really the lens you should bring to bear on this. I think one of the things Charlie would have done is, he wouldn't have been so uncritical about the things that aren't so great. We tend to wish away all that we don't like. So we have a little bit of this selective retention bias. As an economist, surely you're much better qualified than I am, but very few countries which run a combined gross fiscal deficit close to double digits will find that they can sustainably maintain that.
Yeah, there is
It's not easy.
growth on steroids.
It's not easy to do it. And so that's one thing that sometimes I worry about. I think certainly all that you spoke about, the demography, but it needs to be...
Savings, I mean, we're getting an explosion of savings and
Right.
financialization.
But I think all of this needs to be harnessed in a way that is productive.
Yeah.
So the demography doesn't count for very much if you don't focus on healthcare and education.
No, if it was left to Charlie Munger, he would have, rather than invest in steel plants, invested in education.
Primary schools.
Yeah.
I think that's where Charlie would have gone in India. He'd have focused on primary schools and primary health centers, because to really be productive, you need to be in good health and well educated. It's not enough to say that the 15 to 64 population in India is something fantastic and very different, and the number of dependents that each person serves is much lower than in China. There's a graying effect in Japan. That's all true. But at the end, how do you make it happen? He had a wonderful word for this. Though I don't think he'd have used it in the context of India. He should love this word. I heard it the first time when I went there with Raamdeo. It's called the Lollapalooza effect. So if good things come together, multiple good things come together, then you have a force multiplier that is just truly, truly exceptional. It just knocks the hell out of things. And I think the difference is, if you look back at America and go back 50, 70, 100 years, I think they did a lot of the building blocks. They got the building blocks right. And the building blocks led to Lollapalooza effects in the US. And I hope it happens in India.
Absolutely. Okay, over to you, Raamdeo.
Thanks, Latha. Mohnish, since we have you all the way from Austin, I'll ask you this question. I'm going to read a Munger quote, and then I want you to give me the color on it as you see fit, and I hope you recognize the quote. Munger once said, he's a manager that all investors, CEOs, would-be CEOs, and MBA students should study. Who was he talking about?
Well, I think would be Jim Sinegal at Costco, Mrs. B possibly.
No, not quite. It was Henry Singleton of Teledyne, who
sure.
He admired so much for his thing, for his capital allocation, his brute rationality. Just to inform your audience, Munger has said that Singleton would play chess at the grandmaster level blindfolded. He was that good at capital. He started the concept of buying back shares elsewhere. If you know the story, would you, towards his deathbed, Singleton wanted to sell Teledyne to Berkshire Hathaway, and the transaction could not be consummated. Why is that?
Well, so Singleton, I mean, he was amazing. He, from 1965 to 1970, he bought 170 companies. Typically about 10 times the earnings for these companies, but he used stock. His stock was trading at 40 to 70 times trailing earnings. And so, he was using expensive paper to buy good assets. Then from 72 to 84, bought back 90% of shares at single-digit multiples, right? And then at the end of that 84 period, when he had bought back 90%, Charlie knew him. He went to Charlie and said, okay, now, Teledyne's a good company. They also had an insurance business. And he said, these assets are wonderful, Charlie, and, Berkshire would be a great home. And he wanted to sell it to Berkshire. And Berkshire was very interested in buying it. But Henry wanted Berkshire stock. I mean, he was a very smart guy. This guy was, off the charts. And Warren and Charlie were very interested in doing the deal, but they said, we want to pay cash. And so Henry didn't want to do it that way because, then there's a tax implication and everything else. And of course, in 84, Berkshire stock was $400 a share, which is now $550,000. So it would have been a huge home run. So that deal never took place, but just tells you the amazing mind of Henry.
Mohnish, just to add to that, if you can, Berkshire and Warren and Charlie did sell Berkshire stock for one particular transaction. Do you remember which it was and how did it work out for
Dexter.
them? Correct, Dexter Shoes.
Dexter Shoes.
And how did that work out for them?
Warren called it his biggest mistake, other than buying Berkshire Hathaway itself. So they gave away 2%, 2% of the shares of Berkshire Hathaway to buy Dexter Shoes. Dexter Shoes eventually was a zero. Basically, for all practical purposes, that investment went to nothing. 2% is around 15 billion today, and counting. It's not over yet. And so well, I think the big lesson they learned from that was, and this is the great thing about both these guys, is the important thing was that they didn't really dwell on it so much. They learned the lessons and they moved on. And the big lesson they learned is, we're not going to do these stock deals. If we pay cash, doesn't work, that's one thing. But I remember, just to give you a little lesson about mistakes, is that I think it was like 2014 or 15, I had an investment I had made go to zero. So I'd invested about $70 million in this company in the US, and it eventually went bankrupt, went to zero. And I had written to my investors explaining, what happened, etc. And I remember I was about to board a flight from New York to LA, and I get a phone call from Charlie's assistant, and she said, Mr. Munger would like to talk to you. Very rare. I think there must be 2 times in my life that Charlie actually wanted to talk to me on the phone. So instead of boarding, I said, okay, let the flight go. I sat down, I said, yeah, sure, I'll talk to Charlie. And Charlie basically was calling me and saying, look, Mohnish, I read your letter to partners, and you have to be careful. He said, we want to learn from mistakes, but we don't want to learn too much, and we don't want to brood, and we need to move on. So he said the tone in your letter bothered me because I think you're beating yourself up too much about it. So he said, we all make mistakes. It was like, it was like a grandfather calling me. Grandfather calling you at a point in time when you're like not really happy, put his arms around you and said, look, we all make mistakes. I understand that. You need to learn, don't learn too much. The exact words were, you need to learn, don't learn too much, and move on, go forward.
Right.
And that was a tremendous lesson, and he didn't need to make that call. I'm nobody to him, but that was the kind of person Charlie was.
Yeah, great story, Mohnish. Thank you. Great insight. Now, I got one question for all the 3 panelists. I'm going to put you all on the spot. Let's assume you're probably all worth more than that, but let's say you were retiring and you're worth $1 billion each, okay? And God told you that you have to give that $1 billion to be managed by a fund manager. You can't manage it. It has to be managed by a fund manager. And he gave you 5 choices. Who would you pick? A, Charlie Munger. B, Lee Lu. 3, Rakesh Jhunjhunwala. 4th, George Soros. 5th, John Keynes. Mohnish, you go first.
I'll go with Charlie.
Okay. Sanjoy.
None of the 5.
You have to pick one, for argument's sake. This is a fun thing.
Close.
I'm not going to actually take $1 billion from you.
I'll tell you who I would have gone with.
Okay.
Mike.
I'll tell you who I would have gone with, and then I'll tell you out of the 5.
Okay.
Out of the 5, John Maynard Keynes.
John Maynard Keynes, okay.
And I would have gone with Seth Klarman.
Seth Klarman from the... That's good. Raamdeo? I'll repeat the names. Charlie Munger, Lee Lu, Rakesh Jhunjhunwala, George Soros, John Keynes.
Of course, Rakesh Jhunjhunwala.
Okay. It's compounded at 50% dollar terms, so...
Yeah, when you look at his compounding, of course, it's not for 65 years. I think real in compounding thing is that you go in for 50, 60, 70 years. So, with a liver also you can turn the whole earth.
Right.
So, for this old people, this Charlie and Buffett, it's 20% for 65 years. That's the differential, not the rate. Rakesh is all about the rates. It's 40%, 35%. So I'll give money to him. I don't have 65 years. I have whatever.
Great. Great answer, Raamdeo. My last question to you, Mohnish. This is, again, a Munger quote. I want to see if you can guess who he talked about and why did he like that person so much. He says, Of course I admire him. I have a bust of him in my house.
Well, Lee Kuan Yew.
Yes. Bingo.
Yeah.
He did. Why do you admire Lee Kuan Yew so much? He's a politician from Singapore, of course, the ex-Prime Minister of Singapore.
Well, I think Charlie and Warren are both about track record, right? You just look at what Singapore was. 1950, GDP of India and GDP, per capita GDP of India, GDP of Singapore is the same. And look at it today. What's the difference? There's a night and day difference in what's happened. It was a swamp. It was a swamp with bad weather and not
malarial
too much advantage, almost no natural resources. And, from all of that rose an incredible civilization. And he was able to bind together disparate cultures into a very cohesive group which has no conflict with each other. And just incredible. It's all the different things that Lee Kuan Yew got done in Singapore is basically a miracle. I think that and if you think about China, there is no China if there's no Lee Kuan Yew. Deng Xiaoping basically took the Singapore model, set up the economic zones, which got China going on a capitalist path, and then eventually the entire country became an economic zone. And so basically, the spectacular rise of China that we saw does not happen if you don't have a Lee Kuan Yew as the beacon. And if you think about a communist country embracing capitalism, that's the most unlikely thing that could ever happen. So it's just amazing what he was able to accomplish.
Yeah, perfect answer. Thank you again, Mohnish. Raamdeo, let me ask you. Munger always said, and Buffett always says, that what they value the highest is temperament. You don't necessarily need a high IQ, but you need good temperament. What kind of characteristics are important for great investors? What did Munger say and what do you say?
I think having patience. In temperament, I would understand that the kind of compounding, the kind of undervaluation, because they're always looking for what he said, no-brainer. Now, no-brainer doesn't come, at least in Indian market, it's not spread across. But our dear friend Alok, he buys only no-brainers. So there are no-brainers. So you need to have that temperament to keep looking for no-brainers, and then when it comes, as you say, back up the truck and buy it. So I think and then after buying...
As I say, but not do. But.
Not do, okay. But I think the real thing is that having the patience, that a lot of people I meet, particularly now, that everybody wants to earn money very quickly. They don't realize, even if they get one stock right, it is not going to turn their entire portfolio, which is what they should bother about. So the portfolio returns are very different from a stock return. So they should focus on at what rate their own portfolios are growing, at 15%, 17%, 18%. That's the number. If index has done about 12, 13%, if your entire portfolio has done about 17%, you've done a wonderful job. So what is the great thing about Rakesh is that his portfolio itself has grown at, I don't know what number, but it must be closer to 25, 27% and after he's gone, probably it is doing even better.
Yeah, probably amazingly true. And also that he didn't believe necessarily in diversification. He ran a pretty concentrated portfolio.
First time I met him, sometime in 88, 89, I met him. I was stunned. We had tons of shares of all kinds of companies, which also we didn't know what that does. And he had a piece of paper here. He used to keep it here. All his positions will be written here. Speculative as well as investing. And the sizes will be so massive. I said, this guy is coming from different planet altogether. So he was different in terms of focus, having few ideas, betting big. I actually sold Titan in 2003-04 for one of the institutions. And we got tired of selling Titan at about $100 or something. Then it went down to as low as 30 rupees. And then he started buying.
I said,
what the junk he's buying? And see what he's bought.
Yeah, it's been actually amazing. But Raamdeo, you've done, of course, despite what you say, you've done extraordinarily well for yourself. The market capitalization is great. Munger made this quotation. He says, it's not staying rich that's difficult. It's staying sane.
I didn't get it.
It's not staying rich that is difficult. I mean, people get rich and you are obviously. It is staying sane, staying mentally together, that's difficult. Would you experience that? I mean, does wealth play tricks with your head? Are you less likely to listen to people? Are you more likely to dismiss ideas?
Are you saying that am I feeling rich?
No,
He has decided
funny. I know you are rich. I don't need it. I know
he
you
has
are rich.
decided you are rich. It's easy to be rich.
It's also factually true. He is rich.
I know that's true, but I'm saying...
I'm just trying to get your question.
Yeah, my question is, Munger said, getting rich was easy. Staying sane was difficult. Sane, S-A-N-E, sane.
हिंदी में आपको समझाता हूँ. आपका दिमाग फिर जाता है क्या?
No.
बनाने के बाद.
Thank you. That's why we have a lot of friends here, and they keep us kind of
grounded.
sane. Yeah. Every day morning we get good lesson, and so they keep us. They are the huge anchors to keep us grounded.
Can I add one thing? You were making this point about getting wealthy and making. Charlie said one very interesting thing about this. He said, "I want to get rich, but it's not about the money. It's about being independent."
Independent.
So Charlie wasn't trying to get rich because he wanted the money. He said, "I don't want to buy Ferraris
or Lamborghinis." And he stayed in the same house for 70 years.
That's right.
In Pasadena.
So I think this is, again, something that a lot of people need to think very seriously about. Why do we want the money? What is the sense of purpose here?
But let me ask you this. What is Buffett roughly worth today? Roughly.
Meaning after his donations?
I mean, what is his net worth today? Donation is gone. So what is his worth today? Roughly, I'm saying.
I would think somewhere close to 100 billion.
Yeah, 90 to 100 billion dollars, something like that. And Munger, when he died, was worth
1.8. Sorry, 2.6.
2.6 billion. 2.6 billion.
Yeah.
How come there's such a disparity between the chairman and vice chairman?
One is the number of shares they own, I'm happy to say.
No,
that
but
makes a big difference.
Munger, being the architect, could have bought the shares. I mean,
actually, shareholding was in large part when blue chip stamps got merged into Berkshire Hathaway. That was the single largest chunk of his Berkshire holdings. And I don't know, most people wouldn't say what I'm going to say now, but I certainly will. To his credit, he didn't hanker after buying more Berkshire shares, even though he probably knew just as well as Buffett how brilliant the future was. That really gives it away.
If you go back about maybe 25, 30 years, the shareholding Munger had in Berkshire Hathaway was approximately 2% of the company.
Correct.
About 15 billion. So when his wife passed away, she had an accident. She passed away. She had told Charlie that my half, I really would like it to go to my 8 kids. And so at that time when she passed away, the value of Berkshire was about 100 billion. And so his shareholding was about 2 billion. And I remember his assistant told me, she gets this scribbled note from Charlie saying, transfer so many shares of Berkshire to these 8 accounts, for the 8 kids, okay? And she was actually nervous. She said, Mohnish, this is like $1 billion, okay? And Mr. Munger didn't even talk to me. He just wrote me this note and said, just take care of it. And I'm concerned that all the shares should go in the right place and this and that. And so $1 billion, and the funny thing is, his daughter was telling me, there was 1 year in the US tax code, just coincidentally, there was 1 year where there was no estate tax, there was no inheritance tax. And Munger's wife happened to pass away that year, just by accident. In fact, they used to call it throw grandma off the train year. Throw grandma off the train year to avoid the tax. So anyway, it just so happened that was the year that his wife passed away. And so the billion basically got passed to the 8 kids, 125 million each. And they have done, amazing things with that money. And of course, that 125 million is about 3 or 4 times that today. Actually, no, I'm sorry, it's about almost 7 or 8 times that. So that's kind of how it went. And then the second half, which was the other billion that he had, he just focused on giving that away. And so basically, he had been continuously, for the last probably 15 years or so, pushing that money out with things like the Doheny Ranch and different gifts he made to different universities and whatever. And Charlie was very quiet. Both Warren and Charlie, they don't talk about it, but in the 1960s, they were very strong advocates for the pro-abortion movement in the United States, supported it very heavily when it was illegal. And Charlie worked very hard from a legal point of view for Roe v. Wade to get passed. And we never hear about it. These guys are not guys who ever talk about that. And so that's kind of a little bit of a history of kind of how the money went. And when you talked about the independence, Charlie used to joke, my whole point of doing all this was to get independence. And then he said, I overshot a bit.
A bit. Yeah.
I don't know overshoot. I got just 2 questions I want to get Sanjoy to answer. Sanjoy, first I want you to talk a little bit about mental models that Munger used and which ones do you find particularly relevant. And the second question, I'll just tell you the question right away. You're a professor, at least we call you all a professor, right? So you go to business school, they teach you low risk, low reward, high risk, high reward. Munger didn't necessarily believe that, did he?
Not at all.
So talk about
he
it.
said just the reverse of it.
Yes, so talk to us about it.
I think the interesting thing about the lattice work of mental models, what's become famous throughout investing through all, it's basically about saying that you got to look at problems holistically. You can't look at a problem using just one framework or one. He didn't say this, but he used to love this phrase: to a man with a hammer, everything looks like a nail. And that's really the essence of the lattice work of mental models. And he said you need to know, psychology, you need to know economics, you need to know whatever, probability, theory, statistics, and so on. I don't want to get into all the different disciplines, but what I want to say, and this is one of his great contributions, it is what I would say reasoning by analogy. That's what Munger was really brilliant at. He would know he loved history, by the way. And he could tell you things that had happened 100 years ago, 80 years ago. And he would use all the things that he had learned or knew about what had happened in a particular circumstance 50, 70, 100 years ago. And then when he saw a similar thing happening right now, he wouldn't give the same answer. He'd say, this is what happened then. What is the current context? What can I take from there? And then what has changed? And you need this lattice work of mental models to do both these things. To know
do you use it too? Do you use these mental models? Have you trained yourself?
Clearly, if I had, his brain, that'd be different.
No, but
you can see my.
No, seriously. Do you try to use it in your investment thesis? I mean, a more serious note.
Yeah, I think certainly the simple idea that you use probability to judge upside, downside, and you do it, as you don't come for elegant, refined answers to the second decimal, but you certainly pay a lot of attention to not losing money. I think that's something that,
Rule number 2.
Yeah.
Don't lose money.
1 and 2.
Rule 1 is, remember, don't lose money. Rule 2 is...
And basically it's about figuring out the odds. And you want to constantly, it's not just about investing, it's about life. You want to have the odds broadly in your favor. You don't want to do things that work against you. He said this other thing. Peter Bevelin, I think, wrote a book on this. He said, if you tell me where I'm going to die, I won't go there. This is about the odds, figuring out the odds of surviving. How do you survive? And I think the ones that I really love, but, I haven't got into it in as much depth as he certainly did. The ones he was a great fan of a guy called Bob Cialdini.
Yes, of course, psychology.
Yeah, social proof and persuasion and so on. But the ones I love and which I took on from reading his work, one is psychology, different forms of psychology. And the other I would say is sociology. How do large groups of people behave and what drives their behavior? Why do they behave in the way that they behave? And that is the essence, once you understand that, of remaining rational.
And also incentives. What is the incentives
That is the biggest thing that he said. Every one of us is driven by incentives. Incentives actually rule the world. If you change the incentives, you'll have different outcomes.
Okay,
Right.
may I snatch the initiative then? Or rather, snatch the mic actually. Mr. Bhattacharya, I wanted to, since you spoke about analogy, it occurred to me. A lot of people compare the current period to the 2004 period, or globally, they compare the current period to the 1970s, where there were high interest rates and stagflation. What is the comparison according to you? The global
I wish I was smart
macros.
enough to answer that, Latha. I don't think I have the depth in terms of understanding macroeconomics to really answer that, so I don't want to sort of give an answer to that. Okay. But I think the things that are different significantly today, certainly from the early 2000 part, is that we are much, much better positioned in terms of being much less inward-looking, in terms of being, I wouldn't say a perfectly open economy, but a significantly more open economy. And also, I think the one thing that has changed now and is visible, actually in some areas, is that we are globally competitive in a few areas. And that's a hell of an advantage to have, which we didn't have then. And IT services then was actually labor arbitrage. We love to get carried away with this thing that we turn out these wonderful IT services companies. They're not IT at all. You can't compare, let us say, a company, a Microsoft, to an Infosys. It just doesn't bear comparison.
No products.
Forget products. I think it's the whole level of work that they do. I mean, if you visited the campuses of Google or Microsoft, it's a different world. They don't inhabit the same planet. So now I think for the first time, we're beginning to have companies that actually are competitive globally.
Okay. And finally, I wanted to end with the product that we have, the idea that Raamdeo's team has put forth in terms of economic profit. I wanted your view on, how would you relate it to even what we learned from Munger in terms of, I think, intelligent capital usage. Fundamentally, that's what Raamdeo is driving at, that, use capital well. And those who have used it badly should not be compared with those who have used it well. Yeah. So, any thoughts on,
I agree with, obviously return on capital employed is one of the most important metrics in the free cash flow. When I came in the 80s to India, Latha, a lot of companies would come out with right issues and the so-called QIPs, and the stock would go up, and it would astonish me because they're not using capital, they're wanting more capital. So we tried to look for businesses that throw out cash, throw out dividends, as opposed to diluting equity. They're very few and far between, but when you find them, that's when you want to back up the truck.
Mr. Bhattacharya, same question to you. He uses the word hockey stick performance. Help us identify. I mean, what would be the things you would use to identify a hockey stick performer? I would assume capital allocation would be
It's the pivot around which hockey stick performance works. If you had to single out one, they spoke about Henry Singleton in detail, Teledyne. If you contrast the same period, there's a company called Ling Temco Watt in the US, LTV. It used to be called LTV in the United States. And at that time, conglomerates used to be very, very popular in the United States in the late 60s, early. I don't think there's a person in this room who knows about the existence of Ling Temco Watt. They were larger than Teledyne, by the way. I should point out that LTV was larger than Teledyne. And they went down the chute. So one of the things, I think the pivot around which this hockey stick return works is capital allocation. I think there are 2-3 other things that, generating return on capital employed is also, I think, the size of the opportunity that you confront. If you don't fish in a big pond, it's difficult to continue to maintain an impressive rate of return on capital employed. So if you're trying to buy hockey stick return, I think the first thing you should ask yourself is this business in a place where it can continue to
use that capital of the
for
profits.
a long period of time?
Fair.
Because you're compounding.
Longevity, as Raamdeo usually says. You have to look for the longevity.
Latha, can I use your permission to ask Mohnish a question, which I think is fascinating in the current context? So Mohnish, Mr. Munger had a very interesting take on artificial intelligence. He said, I prefer natural intelligence. When he was asked many years ago, 4-5 years ago, he said, we don't go for the artificial types, we focus on the natural intelligence. But this was said, I think, 5, 7, 10 years ago, I forget exactly when. But more recently, when you happened to meet him, and given all the developments that are taking place in the United States, especially in the last, I would say, 2 years, what were Mr. Munger's thoughts on how AI would shape business and more broadly society?
Yeah, so actually every Tuesday morning, he used to have breakfast. He used to be at the club, but later at his home, with a few venture capitalists. The kind of cross-section, very different group than the one he would normally, interact with. Obviously, he's not investing in that space. And I met some of these folks that he used to meet for breakfast, and I think he was always curious about, kind of what was going on. He obviously had a lot of respect for Sequoia and what Sequoia Capital had done. But I think Charlie was, he was one of the guys who was really good at understanding the boundaries, of where his competence began and ended. And so he never really professed to know that how this whole space would turn out and how to play it and all of that. I mean, he recognized that there would be change, there might be a lot of change, but he wasn't one that would be able to handicap it, right? And so just kind of sidestepped it. Just a side note, just a couple of things that, one time I had a discussion with him where I told him, Charlie, if we fast forward 100 years or 200 years at Berkshire Hathaway, one thing I know that will be around will be the railroad, because the railroad has the right of way, and that's very valuable. I said, I cannot say that about Apple and a whole bunch of other things that are in the portfolio, but the railroad is there, for sure. And so therefore, Berkshire is there, right, because the railroad is there. He said, well, we also have a pretty decent power business, and he said, with the humans with electricity and all that, that'll also be there, right? So he actually had thought about these things in terms of, and both Warren and Charlie, and then he also told me that he expected insurance, and this was one area that he and Warren disagreed on. He expected insurance in the very long run for Berkshire to be a very small part of the business. And Warren always expected it would be a huge part of Berkshire. And they actually digressed. I think one of the things was that, when you look at Ajit Jain's operation, I think that in a post-Ajit world, they will put it into runoff. It'll go into, basically, it will, because they don't have I'm not aware of someone who can run that operation other than Ajit. Just to give you an example, this year, Berkshire Hathaway, after many years, wrote hurricane reinsurance. They were out of the market for many years, and they wrote 15 billion of maximum exposure. So just to give you an example, basically when they write these super cat policies, and I had a discussion, so if they write 15 billion of exposure and some big hurricane hits, or number of hurricane hits, approximately 4 to 5% of the total insured loss would come to Berkshire, which means that for the 15 billion to hit, the insured losses would need to be in the range of about 300 billion for Berkshire to be paying out the 15 billion. Ajit collected somewhere between like 4 to 5 billion in premium. And so, basically in like March of 23, the insurers paid, 4 or 5 billion to Berkshire, and those policies expired at the end of November. That's when the hurricane season ended. And basically, we had nothing. We basically had probably the claims were less than a few hundred million for Berkshire. And so I was telling Charlie last time I met him, I said, Charlie, that's like 4 or 5 billion just straight on the Berkshire balance sheet. He said, yeah. And he said, Ajit's done that about 5 times. So basically, if you think about, like Buffett used to joke that, my parents wouldn't allow me to become a bookie, so I created the insurance business. So the whole reinsurance business, the way Ajit has built it, and the opportunistic way they've run it, it's really, really spectacular. And when they step in, like they stepped in 23, there was a lot of trepidation that other reinsurers had. Climate change, this and that. I think the way they looked at it is that yes, the risks were elevated, but you're getting paid
to take the risk.
A huge amount.
Yep.
Yeah, and Ajit was saying that he had written about 12 billion of exposure, and he called Warren. I think Warren was playing bridge at the time. He said, Warren, I can take it to 15. There are people still offering insurance, and Warren just said, yeah, take it all. And Ajit was joking that Warren didn't even listen to the economics. He just knew that it was going to be a great deal with Ajit running it. So anyway, so that's kind of how they thought about the anti-fragility of Berkshire. Munger had mentioned to me that, a company like Apple, for example, when we look at it this very long-term lens, he says, with the buybacks and all that, tangible assets almost don't exist at Apple, right? So if something goes wrong, we don't really have a backup, But it's very different with the railroad and very different with the power business. And so just insight into kind of how they thought about it.
Fair point. I think we have overshot our time by a significant measure. So thank you very much, Mohnish Pabrai, Mr. Bhattacharyya, Ramesh Damani, and thank you very much, Raamdeo, for hosting such an absorbing conversation. It's a pity that someone whom all the greats would turn to for answers, like the question on artificial intelligence. We have one mind less. That's a huge regret. And I think you all will feel
Latha,
that when
let
you
me
go
say
for
that
the
about that
virtual.
quote of mine. This is a very good quote by Henry Adams, the historian. He says, a great teacher affects eternity because his influence never stops. And I'm very sure that Munger's influence will last for many, many generations.
And there are many teachers here who will walk in his footsteps. So thank you very much, Sanjoy Bhattacharyya, Raamdeo Agrawal.
He lived just few days short of 100 years.
100,
but he'll be remembered for many centuries.
Many hundreds. That's
Thank you, Latha.
Thank you.
Thank you very much.
Thank you.
Thank you, everybody. Thanks, Mohnish, most of all.
Thank you.
Thank you so much. I think all of us know a lot, heard about Buffett, but I think after this panel, we know a lot more about Charlie Munger, and a lot of us will go back and start reading more about Munger going forward. So thank you once again for this exciting panel session. I think a special thanks to Mohnish Pabrai, because we didn't realize it was about 3:30 a.m. there. So I think thank him a lot. Thank you, Latha, for moderating this. Mr. Damani, Raamdeo ji, Mr. Bhattacharyya, thank you so much. Raamdeo ji, maybe I'll invite you to give a token of appreciation to the speakers. We can. Mr. Damani. Thank you everyone for being here, and we have dinner served on the ground floor. Thank you once again for coming and gracing the occasion.